Hi, value investors. Welcome to my channel. ASML is a critical company within the semiconductor industry. You know that this company manufactured and delivered the EUV lithography equipment, which is an advanced machine, an advanced equipment to be sold to companies like Taiwan Semiconductor, Samsung, and soon to Intel. You know that these machines are used to manufacture these advanced chips with a nanometer lower than 7 nodes. So this is important because these kind of machines and these kind of chips have experienced a surge in its demand in the last years. So I would say that as a first sight, this company has a really interesting growth prospects for the future. But of course, in this video, we will try to find out if there are other important aspects that we will need to consider, because there are many Polish investors who are extremely positive with respect to this company, and this is because the monopolistic position that this company has. You know, ASML is the only company in the world that is able to manufacture this EUV lithography equipment here. So in this video, we will try to find out if there are any potential risks that we need to consider in order to determine what could be the fair price that we are willing to pay for this company in order to be covered for those potential risks in the future. So the first thing that I will do is to show you what is the breakdown in revenues in order to understand the business model of the company. Then I will present to you what are the metrics of the company, and I will compare with the metrics of Canon. You know that not only ASML not only manufactures the EUV, but also it manufactures the DUV lithography equipment, in which, well, these machines are used to manufacture those chips with a nanometer higher than 7. So and in this market, the company has two important competitors, Canon and Nikon. So I will compare with Canon in order to determine how much powerful is the market position and business model of ASML compared to Canon. And the third part, I will show to you what could be the intrinsic value that I would consider for this company. You know that it is important to consider different aspects respect to the future in order to calculate the intrinsic value. And of course, the intrinsic value, could change according to the view of any other investor. So I will present to you what could be the intrinsic value that I would be willing to consider, and in that way that will influence in the price that I'm willing to pay for this stock. And in the last part, I will mention what are the risks that I could identify about this company when I was studying this company. So I will share with you what are those risks, and we will find out if there are potential mitigations for each of those risks, really. So I hope that you really have a clear picture at the end of this video with respect to this interesting company. So I will start right now. Now, these are the breakdown in revenues of ASML here. You can notice the different products or machines offered by the company, among other services here. And well, you can notice that the EUV lithography equipment has been increasing its participation here over the total revenues of the company here. And then, well, this percentage has declined here in the year 2022. I mean, for in the second quarter accumulated here, we can notice that it has dropped its participation over the total revenues to 28%. Probably, well, it could be explained as part of the supply chain constraint, really. But of course, we need to see if this percentage could be kept at the end of this year here. So something really interesting is that, well, you know that the EUV lithography equipment in that product, the ASML has a monopolistic position here, and it is expected that in the following years this product will be the most important source of revenue for this company here. Now you can see here that these are the number of units here for each of these products here. And you can see that in the case of the EUV, this is just a low number, but it is because, well, it is not easy to manufacture this kind of advanced machines. But of course, you can notice that the price per unit are extremely expensive. Look at this. If you divide just the total amount of money by the number of units delivered in each of the periods, you can see here that the average selling price of these machines has been increasing over the years from 108 millions per unit to 170 millions per unit of this EUV lithography equipment here. In the case of the DUV lithography equipment, well, you can see that just dividing the total amount delivered in each period by the number of units produced and delivered, it means that in average we have something between 24 and 29 millions dollars per unit here. Okay, so it is important to understand this. And something really interesting to know is that in the terms of the clients here in the year 2021, the most important clients of the whole products of ASML is Taiwan Semiconductor with 37% and Samsung with 29%. So both of them are representing more than 60% of the total revenues of the company. This is, of course, something that we need to consider here because this is a risk, of course. If you consider that, for example, that in the following years, Taiwan Semiconductor or Samsung could change their respective strategy, or if they feel that they have so much overcapacity, of course, the demand for the machines of ASML could experience a decline, and that's something that could affect its growth prospects and finally its valuation here. So it is important to consider these things because most bullish analysts are not taking into consideration these kind of risks really. Another important point is the breakdown by country here. You can notice that these are all the countries to which ASML deliver its products or its machines. And you can see here that in the case of China, China has been representing something between 12% and 17% of the total revenues of ASML. You know that according to the law passed by the US Congress in the last year, well, the company ASML cannot deliver its EUV lithography equipment to China, and right now they are planning, I mean, the US Congress are planning to stop delivering the EUV lithography equipment as well. So that would mean that, of course, the growth prospects of this company could change in the following years as these two type of equipment cannot be delivered to China. Okay, now this is something that you need to take into account. Another important point here is that Taiwan represents 32% or more than 30% of the total revenues of this company. So really, I mean, there is certainly some geopolitical risk here. And of course, this is something, for example, what happened if China decided to invade Taiwan, of course, that could slow down even more the growth prospects of this company. So this is the kind of things that we need to take into account if we want to calculate the intrinsic value for this company. And of course, this is despite the fact that I consider that this kind of invasion, or that event could be the worst case. And of course, I would say that there could be a minimal chance that this is something that's going to happen really. Now, this is the market share of the company here. You can notice that this is the market share in the different products, or I mean, in the different industries in which the company has presence. For example, in the case of the EUV, you know that it enjoys a monopolistic position here. So the EUV lithography equipment has the 100% of the market share in that market. Then, well, in the different DUV products or DUV machines here, the company has a really dominant position with 80% in the immersion, 70% in the dry, and in the KRRF 80%. So this is really a dominant position even in those markets. So really, Nikon and Canon, I would say that they do not represent a real threat to ASML, at least currently, because of this dominant position of ASML in those markets are really remarkable here. And in the case of the I-line system, well, the ASML has only 25%, but of course, this is not a business line so much important as it is, for example, the EUV and the DUV lithography equipment here. Now, these are the metrics of ASML here from the year 2012 to the year 2021 here. And the first thing that we will see here is the growth in sales here of this company, which have been really consistent over the years. There are several years in which the company has been able to delivered double-digit growth here. Well, you can notice here in the last 2 years, the growth of this company has been outstanding here, okay? So really, this is the, I think that this growth in sales could continue here in the following years, given the fact that, for example, in the year 2025, it is expected, according to the management, that the EUV lithography equipment could represent more than 50%, more than 60% of the total revenues, which could increase, of course, the power of this company to set higher prices, and of course, probably compensate with the higher prices in cases in which the demand could slow down really in the following years. Okay, so really this is a really good something good, but of course we need to take into account that, of course, nothing is guaranteed in the future. So even if the management is expecting this kind of percentage of the EUV lithography equipment, well, many things could happen in the next few years respect to the in this particular market here, in which you know that there are other companies who are trying to, of course, to replace the EUV lithography equipment. There are several projects of different companies, and this is something that I will mention in the last part of this video. The company has demonstrated to be really outstanding in terms of the net margins here. Look at this, more than 20% in most of the years, and the year 2021, 31%, which is an indication really that the company has a power in its in the EUV and in the DUV lithography equipment here. So really, this is something undeniable that the company has reinforced its market position until right now. In terms of the capital expenditures of a free cash flow, well, you can notice that this is a really rather low percentage, which means really that the company is not an asset-heavy company, as most people may think, really. And this is because the company do not have the 100% of the manufacturing, of the control of the manufacturing process. And this is because the company really relies in more than 4,000 different suppliers that manufacture the different components that then are used by ASML to assemble all these components to build these machines of the EUV and DUV lithography equipment here. So really, if you, for example, in the case of the heavy company, you can notice that the capital expenditures over free cash flow could be even higher. For example, 40%, 50%, 60%, 70%, and so on. Okay, so this is something good for this company here. And in terms of the return of equity here, you can notice that the return of equity in general has been increasing here over the years until, well, more than 20% here. In general, this is a really good result of this company, which indicates that the company really is profitable, of course. But in the year 2021, there has been an important surge in its return over equity of more than 100%, which is something that really caught my attention, really. And you know that the return of equity is the division between the net income by the equity here. So this increase could be explained by the increase of more than or something like 50% in the net income, but at the same time a decline in the equity here. Look at this. We will focus here in the equity because this is the first time in which you can see here that the company has dropped in its equity here. So we need to find out. I just was wondering why this happened in the year 2021 here. Okay. So here we will go directly to the financial statements of the company here. And here, for example, you can see here, we go directly to the consolidated statements of the shareholders' equity here. You would notice that the equity in the year 2019, it was 12.5 billion. Then in the year 2020, it was 13.8 billion. And in the year 2021, it has been 10.1 billion, as we have seen in the spreadsheet in Excel. Now, look at this. What is the main component? The main component that explains this drop in its equity. It is the purchase of treasury shares, or in other words, the repurchase of its own shares in the year 2021 here. And nothing less than 8.5 billion. And you know that in the case of the repurchases, they need to be included as part of the equity as negative here. And this is that I've mentioned with detail in my video of the assessment of Hewlett Packard Inc. here, okay, that you can watch in this channel. But then in this case, you can notice here that this 8.5 billion is an enormous amount of money here deployed to make repurchases. So in order to see here, in order to see things in perspective here, we can go back here in order to see that the repurchases here in the year 2021 were really an all-time high. Really, if you can see here, the amount deployed really is really big here in the year 2021. And if in terms of the repurchases divided by the free cash flow here, you can notice that after several years, it surged and up to 86% of the free cash flow here, which is really high, really. This is something that caught my attention because probably you have not seen something like this, but I can tell you that this move of the management do not mean that the company is really shareholder oriented. And the reason is because you need to remember that in the year 2021, the company, I mean, the stock market price of the company was at its all-time high. So how it's possible that the company deployed this enormous amount of money to overpay for the stock of the company? So this is something that truly caught my attention here. And something, for example, I have a benchmark of Apple. You know that Apple deploys something like 86-85% of its total free cash flow. But the main difference with Apple, for example, is that Apple has made over the years deploy a huge amount of money to make repurchases of its free cash flow. This is the main difference here because Apple is buying an enormous amount of money when the price is at its peak, and enormous amount of money when the price is at its lowest point. So this is an important main difference because it means, for example, that a company like Apple is really acquiring its own shares at an average price. So in this case, for example, you can notice that in the year 2021, when it is supposed that the company's stock market price of the company was at its peak, the company was deploying this huge amount of money. So really, I don't agree with this movement of the management here. But in order to see what is some more details about the movements of the management here, you can notice here that the company, in general terms, in terms of the balance sheet, the company is really solid. As you can see here, if you divide, for example, the long-term debt by the free cash flow here, and if you do that in each of the previous years, you will notice that in general, the company does not need so much debt here because it means that in less than 2 years, the company can pay back all its long-term debt using its free cash flow. Okay, so this is really important here. And look at this: in the year 2021, the company has ended up with a 6.9 billion is its cash in balance sheet. Now, this, of course, is good enough to cover the total debt of the company in the year 2021. So apparently there's no any problem here. But if you notice here, if you sum this 6.9 billion to the 8.5 billion that the company has made to make repurchases, it is something like 16 billion that the company had in excess in cash in the year 2021 here. So really, I don't know if really the management was aware of how to maximize the value for the shareholders, but really this is not a move, of course, that truly is shareholder oriented. Okay, but given the fact that something that surprised me is that that this company needs to increase its capacity to increase the number of machines produced because they are not able to meet the demand really. So why this company has not invested so much money in increasing its infrastructure and capacity to increase, of course, the output or the number of machines produced in the year 2021? This is the kind of questions and doubts that I had when I was assessing this company. So that means that really the manager did not know how to use or how to deploy all this amount of money here. Okay, so this shows that probably the company is really good one, a high quality one, but the manager is not so high quality here. An important thing to understand is that the company is not using properly the cash that the company is generating. For example, what I would have expected a lower amount of repurchases here I don't know, probably 1 billion, 2 billion at most. But the rest, if the company do not have not enough opportunities to deploy all that capital to deliver value, probably they could have increased the dividends here. It doesn't matter if the shareholders just need to pay taxes. I would prefer to increase the amount of dividends, an increasing amount of dividends here instead of overpaying for its own shares in the year 2021. So, and of course, something that I would have expected is that this cash on balance sheet could have been lower than 6.9 billion as well. And probably the reason why why the management did have not used this all the investment in more infrastructure right now as it really needs really in order to meet the current demand. It is because probably the what would happen, for example, if the company would have invested most of that money in more infrastructure to increase the output capacity. Most likely, and this is something that I'm thinking, is that the suppliers will not be able to increase at the same proportion the number of production of the components in order to increase in order to increase the number of machines produced, and in that way avoid the idle spaces or idle resources of the new infrastructure, okay, of the new infrastructure invested by this company. There could be, of course, a needle and a space that is not used, so much resources that are not used because of this lack of production, lack of increase in production by the suppliers. And of course, that could have increased the fixed cost and reduce, of course, the net margins here, or the gross margins in this case, for this company. And even in that case, really, it means that the company is not dealing well with its suppliers in order to not make proper planification of an increase in demand here. So really, I think that the manager is not taking good decisions in terms of capital deployment right now. Okay, and particularly in my case, just because we have a not so as outstanding manager, this of course will influence in the price that I'm willing to pay for this stock in the end, and this is something that I will explain to you later in the calculation of the intrinsic value here. Okay, now in order to solve this problem of the equity here, because you know that the equity here has been affected by the huge repurchases of the company that the company has made in the year 2021. So we need to make an adjustment here, and this is something that I explained with detail here in my video of Hewlett Packard here. Well, in order to adjust this, you know that we go again to the consolidated statements of the shareholders' equity here. This account, this item here, need to be that is included as part of the equity as negative because it is part of the accounting rules. We can turn this number from negative into a positive one in order to eliminate that effect of the repurchases here. So we will go directly to the spreadsheet here. And the thing that we will do is that we will add the 8.5 billion of repurchases in order to eliminate here the minus 8.5 billion that is included here. And then again, we will include again the repurchases here, and we will add again here. In that way, we are turning the minus 8.5 billion that is included here within the equity here into a positive one, okay? In that way, you can see here that the return of equity has returned from a 53% to a 21%, which is more consistent with the previous result of the company here. Okay, look at this, how the return of equity has changed really. Okay, so this is something important that you need to notice here, respect to the adjustments, respect to when the equity is affected by the repurchases here. Now, I just want to make a brief comment with respect to the free cash flow in the year 2021 here. You can notice here that there has been a significant jump here of more than 150% of increase in the free cash flow. Probably you would say that this is because the company have experienced an increase in growth in sales of 33% here. But if you notice in the year 2017, there has been a similar growth in sales in the year 2017 of 32%, but we will see here that how much it was the growth in the free cash flow in the year 2017. Just almost 9% of free cash flow increase. So really, there should be other factor that is explained in this search, and it is important to understand it, because if we want to make a decent forecast for the future, if we don't know if there is a factor, a permanent, if this factor is permanent or is just a one-off, we could make a mistaken forecast for the future with respect to the free cash flow here. So we will need to go directly to the financial statements of the company here in order to understand a little bit more about why this free cash flow has experienced this important jump here. Now, you know that this is the cash flow from operations here, the net cash provided by operating activities, and this is the capital expenditures here, the sum of the purchase of property, plant, and equipment, and the purchase of intangible assets here. You know that the free cash flow is just the subtraction between the cash flow from operations minus the capital expenditures. Okay, now you can see here that there was any meaningful change in the capital expenditures in the periods of the year 2020 and the year 2021 here. So really, here the cash flow from operations is experiencing an important jump, and probably most likely this is the factor that we are looking for. So if we dive within all these different items that comprise the cash flow from operations, you can notice here that there has been an important surge in the contract assets and liabilities here. You can notice from the year 2020 here has been an important jump here from 1.4 billion to 5.5 billion in the year 2021 here. So in order to understand, because this is the factor that is causing this amazing increase in the year 2021, we will need to go to the notes number 2 here, okay? And this is the revenue from contracts with customers here. So this is just an explanation in order to understand a little bit more about the different arrangement between ASML and its customers with respect to the recognition of revenues here. Okay, so in order to understand with more detail, we will need to go directly to the chart, to the table, in which we could analyze this account, okay, which is exactly this, okay. This is in the year 2020 and the year 2021. The contract assets and the contract liabilities. Of course, these contract assets are more related to the account receivables. I mean, it is when the contract assets is when, for example, the company ASML has delivered certain services and machines, but the company ASML has not received the payments by the customer yet. So this is just a contract asset, okay? In the case of the contract liabilities, it is when the company like ASML is receiving in advance payments, but the company ASML has not delivered the machines or the services to the customers yet. Okay, so this is clearly a liability. So as you can imagine, of course, these contract assets are located in the balance sheet, in the current assets, or in the non-current assets here. And in the case of these contract liabilities, these are located in the balance sheet, in the current liabilities, or in the non-current liabilities here. Okay, it depends on the contracts here. Okay, in terms of the numbers, you can notice that it is way more important, the contract liabilities here. And look at this, how these contract liabilities have increased enormously in the year 2021 here. So really, what does it mean really? For example, you know that, and this is something that we need to know, that we need to understand that the only way in which a company like ASML could recognize as revenues all the payments in advance that the company is receiving from its customers is when the machines, for example, the EUV and the DUV lithography equipments, are sent and arrive to the customers' facilities. Once these machines or these equipments arrive to the customers' facilities, the company ASML could recognize all the payments that the company have received in advance. Those payments could be recognized as revenues that could go to the income statement of the company. So in other words here, just to make differentiation here of the contract liabilities in negative and positive number here. Well, in negative, it means basically that the company ASML has received payments in advance from its customers, and at the same time the company ASML has already delivered all the machines or equipment or services to the customers' facilities here. So this is why there is any sort of liability here. So this number, the negative, will be included as part of the revenues in the income statement here. Okay, so this number is not part anymore of the liabilities here, and this is something that is happening here and is happening here in the year 2021 as well. And in the case of the positive number of the contract liabilities here, well, it is important to understand that this is a liability because it means that the ASML have received this amount, these payments in advance from its customers, but ASML has not delivered yet the respective machines and equipment to the customers, really. So this is happening here and this is happening here. So this number is not included as part of the revenues in the income statement. It remains in the liabilities in the balance sheet, but in this case, this number is included as part of the revenues, is recognized as revenues here. So this is not a liability anymore because the company has already delivered all the respective machines. So that's why this is here. It says revenue recognized that was included in contract liabilities here. So it's important to understand these kind of things, in this movement in the accountability, in order to understand what is happening here in the process of ASML, really. This is the item here, the remaining performance obligations here, for which consideration have been received. Well, this is the item that explains this surge in the contracts, assets, and liabilities that we have seen in the cash flow from operations here. But you can notice here that there has been an important surge here in the year 2021. And if you remember, in the year 2021, the management decided to implement a new policy respect to these operations. The management decided to implement the fast shipment policy here, in which, well, basically it means that once the company ASML ends assembling all the components to construct these machines, they are sent immediately to the customer's facilities. But what happened before this fast shipment policy? Well, what happened is that once the ASML finished assembling all the components, there were some tests that were taken to the machines before they are sent to the customer's facilities. So basically, with this new policy of the fast shipment, the company is cutting certain parts of the process in order to accelerate the shipments to the customer's facilities. So this important surge in the remaining performance obligations here, it means basically that there have been more payments in advance by the current customers or by new customers, really. And this is because of this acceleration of the shipments, of this fast shipment policy here. What is the implication of this? You need to remember that the only way to recognize revenues is when a company like ASML just deliver the machines to the customer facilities. Once these machines arrive to the customer facilities, ASML could recognize those payments that they have received as revenues. Okay. Now, right now, with this policy of the fast shipment, the company, ASML, not only need to wait for the arrival of those machines to the customer's facilities, it needs to wait for a confirmation by the customers that these machines are working well in their customer facilities. The implication is that there is a delay in the recognition of revenues with this new policy, okay? This is important to understand this because this is just a result of this new policy of the fast shipment policy here in order to accelerate the shipments here. So really, this is an important implication that we need to understand here. Now, if you remember, there were something like 5.5 billion in the cash flow from operations in the year 2021 as part of the contract assets and contract liabilities here. So really that number comes from the difference. I mean, we take, for example, a net contract assets, just subtracting these numbers, the contract assets and the contract liabilities in the year 2020, and the contract assets and the subtraction of the contract assets and the contract liabilities, we will have a net contract assets of the year 2020 and the year 2021. If we subtract both numbers, we will get the 5.5 billion that we have seen here in the financial statements of the company here. Okay, so this is important to understand this. Here, this 5.5 billion, it is just the result of this difference of the contract assets and liabilities in the year 2021 with the year 2020. Okay, so this is just that you know that these changes in assets and liabilities, well, this is the way in which just making the subtraction in all these items in the account receivables, in inventories, and in this in contract assets and liabilities, just making the difference between the current year minus the previous year. We can notice if there have been certain outflows or inflows in cash in the company, and that's how we can find out if there was an inflow or an outflow in the cash flow from operations. So really, this increase, just summarizing here, is because there have been a more current, more contract liabilities, as you have seen in the previous table, and this is because there has been more payments in advance by the current customers or by new customers, in which, well, Asml has receiving orders from the different customers, and this is because of this new policy of the fast shipment here that the company has implemented in order to accelerate the shipments to be delivered to the customers' facilities, really. So as a result, you can see that was something good here. But as you can notice here, this is something that is important to understand. Given the fact that the company, I mean, the management has not decided to increase its output or capacity or infrastructure, the company is trying to accelerate the shipments, cutting certain part of the process. And that, if you remember, according to the management, there were some tests that were taken of the machines in Asml's facilities that were taken, these tests to this machine before these machines are sent to the customers' facilities. And well, right now, given the fact that these tests are not taken anymore, in order to accelerate the shipments, we don't know, of course, what could be the implication of that cutting of that part of the process here. According to the management, according to the CEO, this test did not add value in the assessment of the functionality of those machines. But if they did not add value, why those tests were taken in the first place? This is the question that I have respect to that assertion by the management. So really, this is the kind of thing that really give me doubts respect to the management capacity, respect to the how they are dealing with the operations of this company. So really, the implication of this fast shipment policy, it is that the free cash flow will not be affected. In fact, the free cash flow has been affected in a positive way. But in terms of the guidance, in terms of revenues, you should notice that as part of this fast shipment and as part of the delay in the recognition of revenues, the company has reduced its guidance from 20% to 10%. For the next years in growth in sales. You need to remember that in the year 2021, the guidance was 20% growth in sales, according to the management. But once this fast shipment was implemented, the management reduced that guidance to 10% because of the delay on the recognition. This is not because of a potential lower demand of those machines. This is just because of the delay on the recognition in the income statement of the company. So, but this is the kind of thing that you need to take into account here, because honestly, I don't know if this is something that will be the new norm for the future. Even the management is not so sure about that. An important information that I could find out respect to this policy is that in the year 2022, in the first quarter, the company had fire in one of the facilities in Berlin. So honestly, I don't know if it was because of the result or consequence of this fast shipment policy. I don't know, but but something that I didn't like about the management is that they never mentioned the word fire in any of the calls in the first quarter results, neither in the second quarter results. They never mentioned the word fire. They just mentioned that there were some problems in one of the facilities of ASML. So really, but I was informed that some analysts in Seeking Alpha were calling the company in order to know more about this problem. And yes, the company mentioned the word fire in these calls, but why this management did not mention anything about the fire for the information directly to the shareholders? This is something that I don't like. And another important point that is that this fire really had an important implication in the amount delivered, in the amount of machines delivered. For example, in the case of the EUV lithography equipment, in the first quarter of the year 2022, there were 11 EUV lithography equipments delivered, but only the company received cash payments for 3 of them. Whereas in the case of the first quarter in the year 2021, there were 12 delivered EUV lithography equipments and the company received cash for 11 of them, which means that obviously the fire really caused a problem in the delivery of these machines, really, because of course the fire really had an implication, had a consequence in those machines. But this is the kind of things, of course, that I don't like about the management, the lack of transparency here. This is important to understand because here you can notice that the company is really a high quality company, but apparently the management has problems to allocate in an efficient way all the cash generated by the company. They don't know how to deploy this important amount of money. They are making repurchases when the stock market price of the company is at its peak. They are not transparent enough in terms of the problems in the operations of the company. So really, these kind of things I don't like. It is like, for example, the management is a pilot, and this pilot is driving a Ferrari, a high-performance Ferrari. But if you don't have an adequate pilot, this pilot will not get the highest performance possible of this Ferrari. So this is the kind of things, of course, that will influence in the price that I'm willing to pay for this company here. Now, these are the metrics of Canon here. You know that this company, Canon, is a Japanese company that competes directly with ASML in the DUV lithography sector here. So, well, these are the metrics from the year 2012 to the year 2021 here. And well, the first thing that we could do is to explore a little bit more about the growth in revenues of this company. Well, apparently, just looking into these several years, apparently, the company was delivering negative growth here, which means that really most likely the company was facing strong challenges, a strong competition, or mature markets. Because you need to remember that this company, Canon, not only participates in the DUV lithography industry, but also in the printing and image sector, in the healthcare sector, among other sectors, really. So we could see here that there were 3 years in a row in which the company delivered negative growth here. And you need to remember that in the case of the DUV lithography sector, the company is facing a strong competition with ASML. You need to remember that ASML has a market share of more than 70% in the DUV. So really, this is a strong competition for this company here. In the case, for example, of the net margins, you can notice that the net margins indicates lower than 10% here. You can see here that there is not so much power to set higher prices in the different sectors in which the company has presence. Adding to the fact that the company is a heavy asset company because it requires more capital expenditures according to this proportion here of 49%, of 60%, 52%. If you compare these proportions with ASML, which are significantly lower, it means that in the case of ASML is an asset light company, and in this case the Canon is a heavy asset company here. So really we have a company with the limited growth prospects because of the competition, because of the maturity of the markets in which the company has presence, adding to the fact that the company needs to use more capital expenditure. So until now, this company is demonstrated to be a lower quality than ASML really. So as a result of that, this return of equity is lower than 10%, which is something that I don't like really. It means that basically the company, whenever it has to reinvest into its core businesses, the company will get a lower return for its capital, which is something that I don't like. In the case, for example, of ASML, the company is able to generate more than 20% of return of equity, which is something that indicates a real profitability here by that company. But in the case of the financial leverage, in the case of the balance sheet here, the company is rather stable and solid because the company in just 1 year, 1.1 year, the company can pay back the total long-term debt using its current free cash flow. And this is something that has been consistent over the years in general. So I won't be worried about that. I wouldn't be worried about this aspect. In the case of the cash imbalance, well, this level 2.9 billion in the last year. It's something that is really acceptable here. Now, my curiosity is how this company is deploying or using its free cash flow to deliver value for the shareholders. You know that the free cash flow in a company could be used to make acquisitions, to reinvest into its core business, to make more dividend payments, or to make more repurchases here. And if you notice here in the case of the repurchases, you can notice here that this company do not allocate a significant amount of money to make repurchases. So if the company is not using more money to make repurchases, this indicates that the company is using the money for other purposes. So if we go, for example, to make the dividend payments, well, apparently in the case of the dividend here, generally if you see here the dividends over free cash flow, you can notice that in general the company was using something like 38%, 20%, 48%, 49% of its total free cash flow to make dividend payment, which is something that is really, really good, a good portion here. But if you notice here in the last 3 years, the company has declined its dividend payments here in the last 3 years. So this is something that, of course, caught my attention. And well, if the company is not using much more money to make repurchases and it is reducing the dividend payment, it is because it is increasing the payments in other purposes. Probably the company is investing, but we can see here in the total debt here, the total debt of the company has been reduced here in a significant way in the year 2021 respect to the year 2020 here. It could mean really that the company is using part of its resources to reduce its financial leverage, which is something that is not bad here. And another important point is that, well, given the fact that this is a company that is facing different challenges, strong competitors, or the maturity of it, in the different sectors in which the company has presence, I would say that the company will really needs more money to reinvest, more capital expenditures, just to keep its market position in the different sectors in which the company has presence. And this is something that I don't like, because a company that really requires more capital just to keep its market position, that's something that in the long term, of course, the value that this company could deliver to the shareholders is rather limited here. So that's why I consider that this company, of course, is way lower in quality than ASML here. And something that I want to mention is that this company is in a project with Toshiba to challenge the market position of the EUV lithography equipment here of ASML here. This is something that I will comment in the last part of this video here. Now, in this part, I just want to show you my intrinsic value here, and I will show to you, of course, what are the assumptions that I'm making in order to calculate intrinsic value in this company here. The first thing that I will need to tell you is that I'm not using the DCF, the discounted cash flow methodology here, because honestly, I don't know how the DCF implies that you know how this business model or how this company could behave in the very long term, way beyond 10 years. And honestly, given the fact that we are talking about a high-tech company, with a complex business model, I would say that it is really difficult to not think that it could be disrupted at some point in the future, at least in the very long term. So that's why I prefer to use this model with an horizon of until the year 2026 here. So we will start here that the first thing is that we will need here the outstanding shares here of this company. And this is the, for me, this is one of the most important factors, the free cash flow over revenues here. Of course, at first we could notice that we could find this factor just looking into the metrics of this company in the last 5 years or in the last 10 years in order to make an approximation here. But I will change this in order to see how the intrinsic value could change really, okay? Now, in terms of the sales growth here, I'm assuming just a 10% until the year 2026 here. And this is because if you remember, the management has to reduce the guidance of the company from 20% to 10%. And this is just because of the implementation of this fast shipment policy in which the company will need to delay the recognition of the revenues. I mean, all these payments that the company receives in advance will need to be delayed in terms of the recognition of revenues. And of course, that is something that will slow down or will reduce the guidance of the revenues for the future. Okay, this is something, of course, that I explained to you with detail previously. So really, this is, but of course, you need to remember that this is not because that the demand for these machines are slowed down. Okay, no, this is something that is not happening. This is just because of the delay in the recognition of revenues. Okay, in the case of the revenues, you know that in the year 2021, according to the last annual report, the company has reached 18.6 billion. Then, well, we will need to just apply the projections that we are considering here. And in the year 2026, we will need to estimate what could be the free cash flow in the year 2026 here, okay? Now, I'm just assuming 25% of proportion of free cash flow over revenues here. If you multiply these revenues by this proportion, you will get an estimated free cash flow here, okay? Now, if we go directly to the metrics here, you can notice that except in the year 2021, the company was delivering something between 16%, 22%, 20%, 25% in free cash flow generation over revenues, okay? But in the year 2021, there has been a surge to 53%, okay? And that was because of this new policy that the company has implemented in the year 2021, which is basically the fast shipment policy that implies, of course, that the current customers or new customers are making more payments in advance here, and of course that boosts the free cash flow of the company. Okay. Now, something that I've noticed here is that in the year 2022 here, in the year 2022, as of July 2022 here, if you notice here, the company has generated this 8.9 billion. Which is slightly higher than the result of July 2021 here. But if we go directly to the free cash flow generation here, you will notice that the free cash flow was affected here. You can notice here from the year 2021, okay, the cash flow from operations. You know that the free cash flow is the subtraction of the cash flow from operations minus the capital expenditures, okay? The expenditures are the sum of the purchase of property, plant, and equipment and the purchase and intangible assets, okay? Now, in the case of the cash flow from operation, there has been a decline here. And even when you have a more contract assets and liabilities, and this is something that I explained previously, because of the surge of the more advanced payments in advance here as part of the fast shipment policy. But then look at this, how the net income has been affected here. It was almost flat here, and this is why this is something that has been affected here. If you take, for example, the free cash flow, which is something like, I don't know, I mean, we could more or less calculate 2.4 billion minus this, which is something like 900 million, you will get something like this. 1.5 billion of free cash flow divided by 8.9 billion in revenues, you will get something like 16.9% of cash flow generation over revenues in the year 2022 as of July 2022. So you need to remember here that probably you're asking yourself why there has been this important drop in the cash flow generation in this year. And this is because if you remember, and this is something that I explained previously, in the first quarter of the year 2022, there has been a fire in one of the facilities in Berlin of ASML, in which, well, the management was not transparent enough. And of course, this fire, of course, affected the number of machines, EUV lithography equipments delivered and or sent to the customer's facilities. Okay, so this, of course, could clearly be a consequence of that fire. Okay, we don't know honestly if that fire was a direct consequence of this fast shipment policy implemented in the year 2021. Okay, so really we need to be really conservative in our projections, considering this factor respect to the management here. Okay, so probably you will be tempted to consider a 50 more than 50% of free cash flow generation of revenues, but of course I don't feel so much confident in that number to be sustainable for the next 5 years. Okay, so if we go directly to the model here, to the calculation here, yes, it could be more than 25%, but I prefer to stay to 25% in this factor. Okay, and well, we will change this factor in order to see it, in the end, how the intrinsic value could be changed. Then, well, we have this. If we consider that this is the factor here, then we will divide this number, this free cash flow estimated in the year 2026, by the outstanding number of shares. And then we could consider here a multiple here. This is the multiple price over free cash flow, which is the average here of the last 5 years here. Okay, so in the end, just multiplying the free cash flow per share by this average multiple, we could get a target price for this company in the year 2026 of 703.8 euros per share. Okay, now given the fact that we are in the year 2022, we will need to calculate the present value, and well, my cost of opportunity is something like 8% here. And this is because I consider that ASML is a high quality company. If I would consider, for example, that this is a risky company, I would put something like 12% here. I would demand 12% or 15% here. Now, in terms of the exponent here is 5 because we are in the year 2022. And we are taking the present value in from the year 2026. There are 5 years of difference here, okay? And then, well, we could calculate the intrinsic value of this company. And given the fact that I like to add a margin of safety, I would be willing to pay 335.34 euros per share for this company. That you can make certain changes here. You think, for example, if you trust in this management, and well, given the fact that as you can see here, in the year 2022, the company is generating just 16.9% of free cash flow divided by revenues. So honestly, I don't know how the company will end up with what portion the company will end up at the end of the year 2022. But honestly, it will not be something like 53% like in the year 2021 here. Okay. But anyway, I would say that 25% in the year 2026 is something that could happen, because we need to consider that the management is expecting that until up to the year 2025, the participation of the EUV lithography equipments over the total revenues will increase to more than 60%, because you know that right now the participation of the revenues that come from the EUV is less than 50% of the total revenues. But this participation of the EUV lithography equipment is expected to increase over the years, okay? And of course, that will give the company more power to set higher prices, because of course the company has a monopolistic position in the EUV lithography equipment. And this is expected that this is something that will not change until the year 2026 at least. If you trust, for example, in the management, and if you trust, for example, that there won't be any problems in the manufacturing process in the next 5 years, probably you would say that it could be something like 35% or even more, 40%. Okay, as you have seen here in the metrics, the company was able to generate 53% of a proportion of free cash flow over revenues, and that was, of course, because of the fast shipment policy. And of course, you may see this, that this is more or less aligned with what some bullish analysts are saying respect to the intrinsic value for this company for the next years. this indirectly they are assuming that there won't be any problems in the manufacturing process here. And given the fact that, I mean, if you feel trustworthy and you feel that the CEO is trustworthy, honestly, you can assume this kind of factor here. As I explained to you previously, I mean, the lack of transparency of the management, the lack of skills of the management to make a more shareholder-oriented capital allocation of the free cash flow generated by the company, and all these kind of things. Honestly, I don't know, and given the fact that I'm not sure really if that fire in the year at the beginning of the year 2022 in Berlin was a consequence of this fast shipment policy implemented in the last quarter of the year 2021. So really, I don't know. Given the fact that I have high uncertainty here, I would consider that this is the price that I would be willing to consider here in order to be protected for potential future problems in the manufacturing process of this company in the next 5 years. Well, I would be willing to pay a price of 335 euros per share. But of course, it is up to you. If you consider that the management is truly trustworthy, or you trust in the skills of the management to avoid potential problems respect to the manufacturing process, and if you trust in the management that there is any consequence respect to the fast shipment policy, of course you can increase this percentage here, and you could consider that intrinsic value could reach the 670 euros per share here. Okay, you can imagine here that for me, given the high uncertainty, and of course if I want to invest in this company, I will wait, of course, for a further decline to get into this company really. Okay, and of course, I would like to make a follow-up in the operations of this company in order to see if there is any other potential problem that could happen because of this fast shipment policy, or any other potential problem that we don't know. Because remember that this fast shipment policy implies that there is a cut in certain parts of the operations that took place before this policy was implemented. So really, I don't know what could be the consequence of that. And given the fact that I have uncertainty with that, I would like to be better covered by potential problems in the next 5 years for this company. So this could be, of course, my intrinsic value according to my own particular view here. And you will understand in this part why I was really conservative in my calculation of the intrinsic value for this stock really. Something important to notice is that any stock is subject to any sort of risks, okay? But we need to pay particular attention when we are involved in companies that are complex in their process, or that are manufacturing complex machines or complex equipments here, because there could be more factors to be considered in our prediction or forecast for the following years, particularly if we are long-term holders. Probably this is one of the main reasons why super investors like Charlie Munger or Warren Buffett are not involved in this kind of stocks really, even when they could understand how critical a company like ASML could be for the semiconductor industry. They are just dismiss this kind of stocks just because of the complexity here, okay? And well, this is one of the main reasons why I'm just considering here for an horizon in my calculation of the intrinsic value only 5 years, because of course we know that these kind of companies could be disrupted at some point in the future. But of course, I mean, I consider this could be unlikely for the next 5 years. Well, we will start here. One of the first risks that I could identify is the fact that, well, there are, in the case of the EUV lithography equipment, there are 100,000 different parts from 4,700 different suppliers here. So this is important to understand, because or something wrong could happen with any of these suppliers that could affect, of course, the adequate supply to ASML to manufacture its machines, okay? But this risk really could be mitigated, because I read in the annual reports of ASML that in order to reinforce the robust supply chain, really ASML makes an annual risk assessment for critical suppliers here. So, for example, making a follow-up of the financial health or the change of ownership, and to assess, for example, the potential supply disruption that these suppliers could face in the future. So really, at least even when we know that ASML do not have the 100% of the control in the manufacturing process because it relies entirely in its suppliers, at least ASML is taking important steps in order to reduce the possibility that any of these suppliers could fail in their supplies, really. So this is important to understand, Luis. Now, in the case, for example, in the minerals here, because you know that many of these components really have as a raw material the tantalum, tungsten, and gold. It could be mitigated through this risk because I know that in Europe there are several countries that are taking important steps and decisions in order to secure the adequate supply of important raw materials for critical industries. In this case, for in the semiconductor industry and particularly for companies like ASML. So really, this the shortage of any of these raw materials is unlikely, at least for the next 5, 6, or 7 years. There are, of course, other critical suppliers, for example, like in the case of car sales, that could face a shortage of gas here. You know that, well, these companies are German companies, so, and you know that the Russian government has threatened Europe to reduce the production of a release of the gas, and that could affect companies like car sales. But of course, companies like car sales are taking important decisions to reduce that possibility, switching to oil, for example, in a great part of its operations. Okay, so really, this is something that is happening with one of the most critical supplier of ASML, really. Another important point that I could identify is that, well, I mentioned in this video the importance of the fast shipment policy here and what is the consequences of delaying the recognition of revenues here, and that of course is slowing down the growth in sales expected for this company. But you know that the market is digesting this information here, and well, apparently the market is understanding that this is not because of a reduction in the demand for the machines of the ASML, but it is just because of accounting terms of delay in the recognition of revenues here. Okay. But something related to the fast shipment policy that I was concerned, and this is something that I've explained to you in this video, is the fact that there are some tests that are not taken anymore because of this fast shipment policy. You know that before this policy was implemented in the year 2021, there were, I mean, once the company ASML finished assembling all the different components to construct these machines, there were some tests that were taken to these machines before being released to the customers' facilities. But now, as part of the fast shipment policy and in order to accelerate the shipments to the customers' facilities, those tests are not taken anymore. So we don't know, of course, what could be the potential consequences of that cutting in the operations of certain part of the enter operations in the delivery of these machines. Apparently, well, the management has said in the last quarterly results, they said that these tests did not add value in the assessment of the adequate functionality of these machines. But if those tests did not add value, why these tests were taken in the first place? This is the kind of things that I'm asking myself. With this part, well, I don't like how the management is approaching the answers of the different analysts respect to this matter here, really. So anyway, we need to make a strong follow-up respect to that, because even when the management has said that after 9 months of being implemented this new policy of the fast shipments, the fact that these tests are not taking anymore to the machines are not affecting the adequate functionality here of the machines. But anyway, something that I was wondering is that probably, given the fact that these machines are not subject of this test in the ASML's facilities, well, I don't know if they are overlooking something with respect to the functionality. Probably if the machine starts sending mistaken data in the manufacturing of the defective chips, that these defective chips could be included in millions of devices at a global level. So this is the kind of thing that I don't want to think about the potential consequences of that. But of course, this is the kind of things that you need to make a follow-up, really. Okay. Now, another interesting point is that there has been in the last years an increasing backlog order, and well, it means that there could be some kind of a risk of double order, which means that it is possible that, given the fact that the customers, and given the fact that in the last years there was an increasing pending deliveries of ASML because I mean the demand was really significant. It was possible that some of these customers just are waiting so long for their machines and they just call ASML to cancel the orders. Well, that risk could happen in the case of the DUV, but in the case of the EUV, it is more difficult to happen because when a customer is requesting an EUV lithography equipment, ASML demand an important amount of money in payments in advance. So if the customer just cancel the order, they will not get back. ASML will not get back the money of the customers, really. So the customer will lose its money here. So I don't think so that this could happen. But the most important thing is that if the customers really stop the order or cancel the order in the future, when they really require more machines, they will need to wait again for their machines. And this is something that, of course, that could affect their operations and of course their respective technology. So and their competitiveness, really. So this is something that will not happen. I mean, it's more unlikely that happen in the case of the EUV lithography equipment. And this is important because it is expected that the EUV lithography equipment will increase in its participation of the total revenues for the following years, at least up to the year 2025. It is expected that the EUV lithography equipment represent more than 60% of the total revenues of the company. Okay. Another interesting point is that the management is not aware from where is the source of this huge demand for advanced chips. Really, they don't know what are the companies that are demanding this important amount of chips, really advanced chips, really. So this shortage, we don't know where that come from, really. It is possible, for example, that that the Russian government is demanding this kind of more chips, or there are other particular companies that are demanding these chips, companies that are more involved in the Internet of Things or autonomous vehicles and so forth. But if we don't know what is the source, we don't know, of course, when these companies could have an overcapacity. And this is important because if that happens, if companies like Samsung or Taiwan Semiconductors just have an overcapacity, they will not demand more equipment, more advanced equipments to ASML, and that of course could slow down the growth in sales of this company and could affect, of course, the valuation of this company. That's one of the main reasons why I was very cautious respect to the intrinsic value calculated in my model respect to this company here. Okay. Another interesting point is that the ASML has really a high concentrated sales in just a few clients. And this is important because anything happen to any of these clients, they will affect in really in a significant way the revenues of ASML. For example, if something happened to Taiwan Semiconductor just change its long-term strategy, demanding less EUV lithography equipments, or probably if it's possible that there are other technology that could be used as a substitute of the EUV lithography equipment in the future, well, that of course could punish so high the revenues of ASML here. So the concentration in sales is another important thing that you need to take into consideration, and this is another important point why I was really cautious in the price that I'm willing to pay for this stock, really. And finally, in the case of the future threats for this company, well, you know that Canon and Toshiba and another company are working for 4 years in a project which is the nano imprinting lithography here, which means that basically they are developing or making research for a new technology to be included as part of the DUV, and in that way enhance the performance of the DUV in order to compete directly with the EUV lithography equipment. You know that the DUV only can manufacture a 7 nanometer process node. It is not possible for the EUV, for example, to manufacture a 5 nanometer process, because the EUV lithography equipment manufactured by ASML is able to manufacture this kind of more advanced chip. So really, this is important because, well, I'm not saying that this that this new project could represent a short-term threat for ASML. But of course, something that you need to be aware is that there could be other companies that are working secretly in order to challenge the market position of ASML in the EUV lithography equipment. This is some information that I just found respect to that. I mean, this is from August 2022. ASML faces challenges. New technology is born. 5 nanometer chip can be made without the EUV lithography machine. So really, this is a project that is worked by Toshiba, which is one of the main clients of Canon. Canon is the company that we assess in this video as a competitor in the EUV lithography equipment of ASML, and Nippon Printing here. So they are working after 4 years in research and development here, and well, they are trying to invent, or they invented new technology, the nano imprinting lithography here, to compete directly with ASML. But of course, something important to notice is that, well, this technology is still in its infancy here. So we don't know when this technology could represent a real threat to ASML in the case of the EUV lithography equipment here. But something that we need to take into account is that for the very long term, ASML could be subject of potential disruptions. And this is because, well, you know that the EUV lithography sector is really, I mean, ASML has the monopoly, and it's extremely profitable to get into this market. So there are so strong incentives to develop technology to compete directly with ASML, because you know that there is a shortage here. There is a really important demand for these kind of machines, and most customers are not interested to just rely on just one company with respect to the supply of this kind of machines. So we need to consider this, and that's another important reason why I was cautious respect to the calculation of the intrinsic value for ASML really. So as you have seen, really, ASML is a critical company in the semiconductor industry that enjoys a monopolistic position in the EUV lithography equipment here. But of course, with the purpose of this video was to present to you many aspects to consider that many bullish investors are not presenting to you. So this, of course, will influence in the price that I'm willing to pay for this stock, really. So in the end, it is up to you. On your vision respect to this stock. Of course, it will depend, of course, what is your time horizon. Here, I'm just assuming a time horizon of 5 years, because in 5 years, it's really unlikely that this company could face any sort of potential disruptions here. But of course, something important to notice is that if you are thinking to hold for the next 10 years, there are more possibilities that there are other risks associated to the complexity of the business, to the potential disruptions in the future that could happen and that could threat the market position of this company. So it is important the maturity of your investment here, and it is important to know here that we are talking about a really complex a company with a complex business model, with a complex machines, really. And probably this is one of the main reasons super investors like Warren Buffett and Charlie Munger are not interested in these kind of companies, even when they know, or they are well aware, that ASML is a critical company in the semiconductor industry. And this is because they have a really long-term horizon, and they know that these kind of companies could be subject of potential disruptions here. So really, I hope that you really have enjoyed this video. Please put a like if you consider that this is a video that is adding value to your investment knowledge. Consider to subscribe if you think that this channel could add value to your investment knowledge. I will continuously delivering more and more information respect to different concepts, respect to different companies, always since the value investing philosophy point of view. So I hope to see you in the next video. Peace.